All right, well, let's go ahead and get started. Again, I appreciate everyone taking the time out of their day to attend this webinar on the Gray Fund, a multifamily investment fund sponsored by Gray Capital. This has been the fund is accumulation of many years of work for myself, Alex, and the entire Gray Capital team. We've been focused on single asset syndications, and we've gotten to a point of where a fund is really the vehicle where it makes sense for our investors, it makes sense for us. And really that's one of the key pieces I'd like to talk about today. But the Gray Fund, just as a disclaimer, is only open for accredited investors only. And like any investment decision, I always recommend you consult your own financial and CPA and professional advisors before making any decision. And on that note, the Gray Fund is a 506c offering, which does require a verification of your accredited investor status. And the easiest way to do that is just with a simple letter from your CPA stating that you are an accredited investor. And if you need any help from that, just email William at graycapitalllc.com, and we'd be happy to walk you through the process. Samib, I'm glad you're here. Great seeing you. All right. And again, graycapitalllc.com/grayfund is how to start the process. But let's just start with a little bit of a summary. The goal of so let's start with Gray Capital and our track record and why we think that a fund is the right vehicle for the time and the market that we're in right now. Since launching in 2015, we've invested in over 10,000 apartment units. That's about a little over 5,000 of those have been as a general partner. And then the other half we've invested as an LP, which I think is an important distinction, because we don't just have experience, raising capital and putting deals together using other people's money. We invest our own money, our own capital, not into our own projects, but others' projects as well. And having that experience, seeing how many other operators do run their projects, do their reporting, has really influenced our growth with the goal of building the best real estate investment company and platform that we can, and taking the best of the groups that we've worked with in the past and partners that we've co-GP'd projects, really trying to take the best of all of them and just combine them to make the best vehicle that we can. And I'm going to be moving my video a couple of times just so I can get out of the way of the presentation itself. There we go. I think I'm going to be out of the way. So across those 10,000 units, and specifically the 5,000 that we've co-GP'd, we've been able to deliver a net IRR to investors of over 26% on average for our projects. And we've participated in $1.5 billion in real estate projects to date. And by the end of 2022, we'll have gone full cycle on 10 multifamily syndications as a general partner. We believe in a high alignment of interest. Again, this comes back to we're putting our own money in these projects. The estimated co-investment amount for the Gray Fund is to be around 20%, which could be up to $20 million, which will mean that the sponsor will most likely be one of the largest investors in the Gray Fund. And that really changes the mentality of how a sponsor views an investment, because we're no longer relying on our sole source of kind of profit from the carried interest or the promote or GP split or fees. We're focused on return of our capital just as all other investors are in limited partners. And that really creates a significant alignment of interest. And again, it's not a token amount of 1% or 5%. We are really stepping up with confidence, investing 20% of the fund. And then a high level of transparency and communication. If you're an investor with us currently, you'll have seen this in our communications, our reporting, our webinars. We believe at the end of the day, it's much easier, and it's the better way to do things, to be transparent. We would rather give you the real story of what's going on at a project, the good, bad, and the ugly, and show you how we're going to fix it and that we have fixed it, rather than sugarcoating it. And I think, again, for all of our current investors, they would attest to that being the case. So why a fund? Why is Gray Capital pursuing a fund, and why you as an investor should consider a fund as a vehicle to allocate yourself to multifamily assets. Well, there's a couple reasons. And the first, just for personally and Great Capital, it's a much more scalable model than just doing a deal by deal. We can really build a concentrated strategy, philosophy, themes, and really build our in-house teams in a way that we can be solely focused on acquiring and managing these assets. Another reason why we did is because we kept running out of room in our projects. The last two deals we did were oversubscribed substantially. And what that was leading to is an environment where they were filling up so quickly that investors were kind of rushing to commit. And that, again, that creates an environment where not the proper due diligence is being conducted. And if you have to sit by a computer screen to click the invest button to get into a deal, there's no time to do your proper due diligence. And while it's great to create a sense of urgency, that's not the type of environment we wanted to build. And so with the fund, it allows for more time to be thoughtful from our standpoint at Great Capital for how we're going to execute this plan. It also gives you a little bit more time to think about what is the right strategy, the right vehicle, the right sponsor. And if that happens to be the Great Fund and Great Capital, that's great. But we want you to arrive at that decision based on due diligence, research, and not rushing to a decision. Then there's all kinds of other benefits of fund. The largest one is diversification. We're aiming to acquire 7 to 10 multifamily assets. And that amount of diversification leads to, it really ensures success and it protects from downside, because we can pick out the best projects, in any market in the country, but things can still happen, one project or the other. And we can have a project that doesn't perform exceptionally well, but it won't severely affect the overall return. Now, our hope that we're going to knock it out of the park on all 7 to 10, but having that diversification certainly protects from the downside. And if you're an investor who likes to pick and choose your own deal, which I think is great in building out your own portfolio, a fund can be a really useful tool to add instant diversification to your existing portfolio. Say for an example that you may have you're invested over 5 projects. Well, investing into the Gray Fund, you're going to be instantly diversified then over a combined 15 projects. And again, that can just be a force multiplier for your existing portfolio for you to consider. And AJ, I'm going to get to the minimum and just here in a second. You timed it perfectly. So as I said, we're targeting 7 to 10 multifamily assets. It could be a few more, but most likely 7 to 10. Nope, one project is going to be in excess of 25% over the entire fund to try to keep things balanced and not overly weighted to one asset. Total fund equity, our target is $100 million for a total asset value of around $300 million. So that's basically a 70% loan to cost on average. The term of the fund is up to 10 years. Project holds, though, may be shorter. In fact, we have an opportunity to reinvest within the first 4 years. And so we may sell or refinance projects prior to the 10 years. And there's a chance that the fund could be closed out prior to 10 years as well, but no less than 5 years. The reason for the 10-year term, while I think 10 years is a long time, the idea is to mitigate risk as much as possible and to reduce the variable of time as a factor, which is going to lead us to force the fund to make a decision that if we had time, we would not be forced to make. So if any project needs additional seasoning, if the market turns in a given year that's later in the fund's life cycle, we have the ability to ride out the storm, preserve capital, and in general, create larger returns. But with the ability to reinvest, as I mentioned earlier, we still get the advantage of being able to compound and have a relatively high velocity of transactions to compound returns and to grow returns. Because typically, over just a 10-year hold period, the biggest challenge to that, or the headwind to return, is the low velocity of transactions. We're also we're doing monthly distributions for the Gray Fund. This is a change to our past projects where we did either quarterly or biannual distributions. And then the minimum investment is $100,000 until July of this year. And after July, the minimum investment is going to increase to $250,000. In the past, our minimum investments have been between $50,000 and $100,000. The reason that we chose $100,000 is if you think about investing $100,000 across 10 assets, you're really allocating $10,000 per asset, which is, it's pretty hard to find an investment minimum that low. And if you're contemplating making an allocation to multifamily real estate over the next 2 years, you may be thinking maybe I'll do $50,000 this year, $50,000 the next. Well, in the fund, you can make one allocation of $100,000, still be diversified across multiple assets, but it's done this year. And keep in mind that once you make a commitment, those funds are not due right away. It's only when we actually call your capital, once we've identified assets that we'll be acquiring, that you actually have to send in your funds. So the last piece about the fund, and we're going to get into this in a lot of detail later on, is that we're using a dual class equity structure that allows for a lot of flexibility. And just really generally, again, we're not getting into the details just yet, but one option is going to allow for, it's really focused on income, allowing for, it has a 10% preferred return. Again, it's distributed monthly. But then there's another track more focused on growth that is projected to generate an equity multiple around 3 to 4% over a 10-year period. But in our conversations with investors, very few indicate that they're only focused on income or they're only focused on growth. They're more focused on a balanced approach, looking for upside to grow your capital, but you'd like to receive income and distributions along the way. And the structure that we have elected to use allows for quite a bit of flexibility for all investors to tailor a very specific risk and return profile based on your unique goals and return preferences. So what are we going to be doing? If we really distill down what I think Gray Capital we're the best at, is we're exploiting market inefficiencies in the multifamily market. And so what does that mean, though? What that means is having really insider knowledge and specifically local knowledge of assets and markets, and sometimes going against the grain, and we're going where some investors aren't, because they just don't have all the information, or they're just focused on several very high growth markets. We see these inefficiencies all over the Midwest. The Midwest often gets labeled as a declining region or a very slow growth region. Therefore, it gets some markets that are actually moderately high growth markets get completely ignored and mispriced. At an even more granular level, inside of those markets, and we're based out of Indianapolis, and we have a significant amount of knowledge of the Indianapolis market. There's some assets that are currently on the market that we're looking at right now that we know that out-of-state buyers will misprice these assets because sometimes the locations are relatively hard to quantify and make sense of. But if you know the market extremely well, you do know how to quantify it, you do know how to understand it, and we can see the opportunity. We know where the development in our markets are, what's in the pipeline, because we work with a lot of these groups. We know a lot of the developers that are building the industrial assets, the developers that are building the new multifamily. We're extremely tied into these markets. This is not something where we're just doing all of our research over the phone or on the internet. We're deeply tied to the markets we invest in, and we use that to our competitive advantage. But that's all, nice and great. You can buy great deals that try to give us an upside, but that's just really where it starts. We're all about adding and creating value, and specifically taking a creative approach to elevating communities, improving spaces, and providing high quality housing. Our number one goal is to preserve principal, to make a very profitable investment. What we find that is directly correlated to a very profitable investment is to creating a great space and providing great housing. That is what, in our experience, if you can do all those things, it's a recipe for an excellent real estate investment. And we see ourselves as stewards, not only of your capital, but we see ourselves as stewards of these assets. We may only own them for 5 years, 7 years, or 10 years, but we want to do what's right for those properties for the long term. Again, still making a very profitable investment, but we think doing the right thing throughout the process leads to that higher investment and more success. So let's take a little bit more granular look at the Gray Fund, looking at our strategy, our tactics, and criteria. If you're an existing Gray Capital investor, a lot of this is going to be not new to you, but we've gotten a little bit more specific, really created our filters, so we are really focused on the types of assets we want to pursue. So our investment region, we're investing in the Midwest. Again, a big concentration, Indianapolis. I've got a list of markets here in a second I'll go over, but really the Midwest is our focus, with the exception of Illinois. Growing secondary and tertiary markets, really populations over $65,000. We want to see growing jobs, a growing population, really focus on tax and business friendly climates and environments, diversified economies. We want to see clear economic drivers. We prefer linear historic economic growth rather than exponential growth. We're very focused, especially right now, because there's a ton of construction in the United States. There's a lot in the pipeline. We're trying to find markets that have high demand, but are not being oversupplied. In fact, they are undersupplied. And then just markets that are under the radar that aren't always at the top of the list, and markets that are severely, we think, possibly overpriced or certainly difficult to achieve the cash flow metrics that we're looking for. So what kind of properties are we looking for? Market rate multifamily apartments. We're not focused on necessarily subsidized assets, senior housing, student housing. We may have some seniors at some of these properties, may have a couple students, but we're operating them as market rate multifamily apartments. Strategy, we're always looking for ways to add value. We are value add investors, but occasionally we do find some opportunities in more core plus assets, which are typically newer properties built in the last 5 to 10 years or so. But even with those core plus assets, we are always looking for ways that we can really force appreciation by adding value. In terms of the vintage year, we're only focused on properties that were built after the 1980s or all the way up to brand new. The reason for that is properties built after the mid 80s often have much less physical obsolescence compared to properties that were built in the 1970s or earlier. And so what does physical obsolescence mean? You can't raise an 8-foot ceiling, or a shorter ceiling. That ceiling's always there. The floor plans in the 60s and 70s, they built smaller floor plans, smaller kitchens, small closets, no washer and dryer hookups, smaller bedrooms. And that's not what the majority of renters in 2022 are looking for. That being said, by the 1980s and the mid 90s, they were building apartments much closer to the types of apartments they're building today. Obviously, the finishes are different. They're not as nice. But the bones of those assets still really are nice. They have a lot of great features, amenities, and a lot of the kind of the key points and features that you, a renter and a resident, would be looking for in a more or less modern apartment. So our strategy, we're forcing appreciation with value add tactics. And this second one is, it's hard to underscore, but harnessing the existing organic growth that we're seeing in the multifamily market today. The difference between effective rents, or the rents that are actually being paid by residents at properties, compared to current market rents, what are just being advertised, and maybe only a few apartments have actually been listed at. The spread is anywhere between 10 and 30% between effective rent and market rents. That is set to be absorbed over the next 2 years, not including any additional rent growth from the inflation that we're seeing today. So if inflation ended tomorrow, we go back to a normal 2% inflation, we still would absorb this organic growth that has already occurred. It's almost like we see the flash before we hear the sound. We've seen the flash of the market rents. Rents are one of the most sticky prices in all of the economy. They very rarely go down. And we know that market rents will be moving up to that point. And we did a great interview with Noah Stone, one of the chief analysts over at Berkadia, kind of digging into this topic just a couple of days ago. And a lot of this growth is baked in. So we're going to be taking advantage of that existing organic growth. Geographic cap rate and debt arbitrage. That's essentially this gets back to the market inefficiencies. Slightly higher cap rates with the same debt. In the Midwest, in Indianapolis, properties trade anywhere from 25 to 100 basis points higher cap rate, but we're going to use the same debt. So we're getting more cash flow with the same, that low cost of capital. So it's a very attractive arbitrage. We're highly focused on data. We're constantly looking at the latest reports, feeds, tracking supply, absorption, and really kind of letting the data point us in the right direction, but then using our own intuition and our knowledge of the markets to make those final decisions. We're leveraging a very deep broker network, as well as going direct to owners. We've got great relationships with all of the major brokers in the Midwest, again, especially here in Indiana. Then high alignment of interest. That's part of our strategy. That's to keep everyone moving in the same direction. Again, the GP we're investing, it says 15 to 20%, but it's going to be 20% of the entire fund. And then we're using moderate leverage, around 70% loan to cost. And again, so what are we going to do? The tactics that kind of revolve in this strategy: light to medium value add renovations, winning the amenity wars, which can be relatively low cost, but high impact investments. We've brought construction in-house at Gray Capital to maximize efficiency. We're also going to be bringing property management in-house over the next year. And we do have a proven ability to drive net operating income and returns with operational efficiencies. And on that note, just here's just two case studies that are good examples of our ability to drive NOI through operational efficiencies. And the first one is Villas on Fur. I think we probably have some Villas on Fur investors here on the webinar itself. It's a beautiful asset up in Granger, Indiana, 2018 construction. It's the type of project you would not anticipate to have high cash flow, given how new it is, how nice it is. We cash flowed Villas on Fur at 13% cash on cash in 2021, its first year of operation. And that was due to two main factors. One, we were able to significantly reduce expenses. It was being run, had a very bloated budget from the merchant developer that built it and who was managing it. We also found some great opportunities to raise rents. We didn't even forecast raising rents too much. We just were really going to cut expenses. We ended up doing both. And then while all that was going on, cap rates compressed. So when we took a valuation on that today versus what we purchased it, this is just over a year's time, that asset value has increased anywhere between $20 and $30 million, depending on which kind of cap rate you choose to take that value at. So that's been a great investment for us over the last year or so. Suncrest Apartments, it's a newer investment to Gray Capital. We're in the middle of executing the plan, but it's a great example of a slightly older asset, kind of mid-'80s construction, where we're really adding amenities and elevating the curb appeal, really to make the asset much more appealing compared to the competition. But again, this is an idea of, we know why this location in Indianapolis is so strong. It is near millions of square feet of industrial, logistics, e-commerce, employment, and jobs. And there's almost no new construction, no new supply in the pipeline. And that's going to be a consistent theme that you're going to hear, is that there are these markets that are seeing incredible amount of demand that have just been skipped over from developers for one reason or the other. And it's creating a very unique investment opportunity. Briefly, just some of the investment themes that are really driving a lot of the decisions, what we're seeing in the current market. That first is e-commerce, logistics, and transportation. I was just touching on that. Indianapolis, it's crossroads of America. They're the second largest FedEx hub in the world. And again, there's currently 22 million square feet of industrial warehouse space currently in construction. And these are areas, parts of the city that are not seeing new housing development. The majority of housing development is in the downtown and the northern suburbs. There's nothing on the east side, the west side, or the south side where all of these jobs are coming online over the next 2 years, and good paying jobs. Suburban momentum. This doesn't need a big explainer. I think everyone's familiar. The drive out of downtowns to the suburbs, more space, a little bit more room to breathe. It's kind of also correlates with another theme. I'm skipping ahead a little bit on, but the downsizing baby boomers, one of the largest generations. they're moving out of those large homes. They've been empty nesters for a while now, and they're looking for something a little more convenient, something that they don't necessarily have to purchase, something a little bit more flexible. And they may be moving into more of a retirement home, something else over the next couple of years, not looking to buy a home. And we see a lot of assets, especially suburban assets, that are filling up with downsizing baby boomers. Favorable tax and business markets. That's why we love the Midwest, Indiana especially. We really like Kentucky, Ohio, and Michigan. Little less tax friendly, but still great compared to Illinois. Meds and eds. This is a consistent driver. Stable jobs, growing jobs, relatively sticky tenants. So whether this is college towns that have additional economic drivers, or near strong hospital systems, growing hospital systems. And the third theme, I mentioned downsizing baby boomers. The last theme, sixth theme, and this is really just, it's very meta. Almost an ad that's just inflation. How accretive multifamily investment is during an inflationary environment. It's hard to understate that we're in one of the better environments for real estate investing. There's only a few asset classes in real estate that outperform and track inflation better. Marcus and Millichap did a study on this a couple of weeks ago. Hospitality tracks inflation the best because you're re-signing your room, you're renting out rooms on a daily basis. But apartments, you're signing new leases at the minimum of a yearly basis. We're really signing new leases on a daily basis, and certainly in a fund across 7 to 10 assets, we can track inflation on a daily basis. Just an overview of some of the main target markets we're focused on. This looks like a lot, but where we really are more focused, and this may appear. Our main targets are the states of Indiana, Ohio, Kentucky, and Michigan. In Indiana, Indianapolis is our main target. We'll have several assets in the Indy market, and then several assets kind of spread out throughout these other markets. Other markets in Indiana that we have invested in or currently have assets in: the Fort Wayne, Bloomington, Lafayette, including West Lafayette, Evansville, and South Bend. Over in Ohio, Cincinnati, Columbus, and Dayton are our preferred markets. Moving on to Kentucky, Louisville, Lexington, and Bowling Green are all markets that we've done a lot of analysis on. We spent a lot of time in all of those markets and have invested in those markets in the past. Then Michigan would be a new market for us, although we've been trying to get into Michigan for quite some time. Grand Rapids, Kalamazoo, Lansing, and Ann Arbor are all on our target list. Then there's a handful of markets out there that we have been monitoring for some time, that we have broker relationships in. We may not make any allocations to these markets, but there's a possibility we find an incredible opportunity. We have the operational capacity to go into this market. So if it's somewhat far away from our headquarters, we may look to, there's a minimum scale we would want to see before we go into those markets. Let me just move my video so you can see the rest. But there's a list of these markets, St. Louis, Kansas City, Des Moines, Milwaukee, Madison, a handful of Tennessee markets, Chattanooga, Clarksville, Knoxville. The furthest away would be Tucson, Arizona, and Albuquerque. Tucson, my mom lives in Tucson. I spend quite a bit of time in Tucson, Arizona, and have been learning the market, know some brokers out there. And so it's just a market that we track. It also checks all our boxes in terms of a market outside of it being in the Midwest: Raleigh, Durham, Asheville, Omaha, and a couple Florida and Colorado markets, just because they are incredibly attractive markets that we're tracking. This is more for just transparency, what we're looking at. But I would say with 90% certainty, our target markets are all going to be in the Midwest in these 4 states. Just another quick deep dive on Indianapolis, because we are certainly going to we have a handful of LOIs already out in the Indy market. We're going to be sending at least 3 more this week. We've got a very robust pipeline. But just some quick highlights why we love Indy, not just because we're from Indianapolis. We keep going to other markets and we thinking the grass is greener. Indianapolis has some things going for it that should not be discounted. I'm going to get to supply. It's a low supply market, which is crazy. We have a ton of developers in Indianapolis, but we still have low supply. Only 2,600 units are currently under construction. That's only 1.6% of the current inventory compared to 3.8% in the United States. Out of that 1.6% of inventory, like I just said, almost all of it's downtown or on the northern suburbs. So we have incredible growth on the west side, to the far east side, and the south side, really focus on these logistics jobs with no new apartments coming online. There's some single family homes being built, but the residents that we're targeting aren't going to be able to afford those $400 to $600 homes. We are seeing in Indianapolis the least amount of multifamily construction since 2012, which is crazy. It's one of the least active development markets in the U.S. And again, in 2022, the amount of deliveries that we're going to see represent only 50% of absorption over the last 2 years. And so what that means, over the last 2 years, we had about 5,000 units of absorption. That means demand outstrips supply by 2 times. You're not seeing that in a lot of other markets, hardly any. On the demand side, market rents are forecasted to grow at least 7% in 2022. Effective rents are still 20 to 30% below. There was 18% rent growth in 20 of last year, 5% downtown. Majority of submarkets are 97% occupied. This metric blew my mind when I finally reached it up. When I saw it yesterday, so I'd seen the November numbers. The January unemployment rate for Indianapolis is 1.2. I believe that's the lowest on record. 1.2% unemployment rate. That's compared to, this is a December number for the United States, but 4% unemployment in the U.S. Obviously, the job participation rate is down, although in Indy, we have gotten back to at least parity prior to the pandemic. And then 4.6% population growth over the next 5 years compared to 2.5% in the U.S. So it's not like this is a shrinking market. We need housing stock. It's just not being built, or the right housing stock isn't being built for most residents looking to rent an apartment. There's some graphs just to illustrate this. I mean, you can see just our vacancy rate just really declining. And I would say comparing it to the United States vacancy, Indy has always been a little bit above the United States vacancy rate. But the trend line of Indianapolis really began in about 2014, where the U.S. vacancy had essentially been flatlined for the past several years. And you can see in 20 and 21, you can see how much absorption really just outstripped demand. And then looking forward into 2022, you can see how really the past 3 years, you can see how these deliveries are just falling off. This is our construction starts in Indianapolis. You can see going back to 2012. I mean, look at 2012, again, going to 22. We've been building less and less, and the problem of the demand for housing has only grown and grown. Market rent per unit and rent growth. I mean, again, we had some great rent growth last year. It's projected to continue. My only quip with this forecast is it's a very difficult time to predict, but essentially what they're doing is reverting to the mean in order to kind of get back to a long-term historical average. So I think it's a little bit of a lazy analysis, but even with that lazy analysis from CoStar, they're still projecting rents to be far above historical norms over the next few years. And again, this is market rent growth. We're not assuming significant market rent growth in our models. We're assuming the baked in market rent growth that has already occurred last year and not forecasting significant rent growth, further growth. We're just catching up to where the market's already moved. Again, 22 million square feet industrial under construction. I mentioned FedEx, CSX regional headquarters, just some major employers: Eli Lilly, Roche, Elanco, Salesforce, Infosys. A lot of sports in Indianapolis. The Final Four was here. We hosted the Super Bowl back in 2012. We really built kind of a convention business, as well as an amateur sport and a kind of a pro sports environment. And Indy is affordable. And Indy is incredibly affordable. Again, just back to this market rent on this yellow line is the United States, and compared to Indy, which is this, I think it's orange. I'm slightly colorblind. So, but you can see that gap between Indianapolis and the rest of the nation. And one of the reasons why a lot of people move to Indianapolis, why we have a lot of migration from Chicago, is because it's more affordable and taxes aren't insane. All right, let's talk about the gray capital pipeline, because I think a lot of people, so Steve, thoughts on the Illinois market? I think there are some good markets in Illinois. The taxes just make it unpalatable for me, the unfunded pension liabilities and the political environment. There's just more, there are other markets that I think have less risk factors that are closer to us. Those are our thoughts on Illinois. I think there's some opportunities for those people who really understand the Illinois market, but we find better opportunities elsewhere. Back to the pipeline. We have the fullest pipeline we've ever had. And I can see a lot of people saying, well, this is a great idea. You want a commitment from us, but what if you don't get any deals? And I've made this commitment that's going to be sitting out there. That's not going to be the case. Our team, led by Jay Reeder, has built an incredible pipeline of assets that are checking all of our boxes. Now, how many of those will we win? We're not going to win the majority. We're going to be outbid. But it's a numbers game, and we are putting up enough attempts on quality assets to be able to fulfill our targets over the investment period. Our real goal, though, is if we could raise $100 million this year and allocate this year and take advantage of the incredible amount of growth that's happening right now. Are we going to see inflation in 2023? Probably. But I know this year we're going to see an incredible amount of growth. And to be able to lock in interest rates with rates today, at prices today, and rents today, versus them growing significantly over the next 24, 48 months, I believe now is the opportunity rather than waiting. In our pipeline currently, we have 23 assets that meet our acquisition criteria. A little over $500 million in assets, a little under 5,000 total units. One example, we actually just made our best and final offer. It was due at noon today. This is a project in Indianapolis, just south of Indianapolis, in the Indianapolis MSA, 1997 construction. Project IRR, we're penciling in around 18.83. That may go down slightly if we have to negotiate, but strong cash flow, a little over 10%, a little over 2.2x over 5 years. We also have 2 LOIs out right now. One in Bloomington, which actually we just found out we lost a couple minutes ago before this webinar started. Then we have another 122 units in Indianapolis that we are waiting feedback on. But just over the next 30 days, we anticipate sending 9 additional LOIs out on assets. And you can see this map. Most of these are in Indianapolis, several are in Ohio, several are in Kentucky. And then we've got a couple deals that are just floating all around that don't necessarily meet our market criteria, like in Austin, or these assets in Pennsylvania, but they met our other pieces of criteria. All right, so I want to give you a little highlight of the types of projects we're looking at. These are all images of assets we've either made bids on or have bids on currently. And there's a couple themes. We're looking at a lot of mid-1990s built product that has very low physical obsolescence, but the interiors are mostly classic. So you can see in this picture as an example, and they've actually already redid the floors in this unit, but the layout is fine, but we could remove that elevated counter, knock that down, swap out the white appliances with a stainless steel appliance, add new fronts to the cabinets, probably just refinish those, possibly replace, but I think we could probably improve them with some hardware and some paint. They've already changed the lighting up. There's just a few things that we could do to really elevate this asset. And so many of the other features of the property are very, very modern. Here's another example, similar mid-1990s construction. Look, at some point they came in and they put in new LVT floors. But the cabinets, they're old. The plumbing, it's old. Black appliance is fine, but the countertops, I think even a manufactured product, not just the vinyl, I think could be a better product. In some of the assets, even a granite or a quartz countertop would be the way to go. Here's just another example. Again, it's a fine unit mix, or it's a fine floor plan layout. It looks old and it looks dated. And with no new supply coming online, we can make these the new supply. There is a demand for, I would say, not super high-end luxury, but for premium units that people really feel comfortable and they can call home. But this is what I'm talking about. Again, this is another picture of one of the assets we currently are bidding on. The units inside are a little bit, they need a lift, but the exteriors, the amenities are very modern. They're very attractive, and is not going to take a lot to make this appear very similar to a lot of the newer Class A product, but will be hundreds of dollars, even after renovations and rent increases, will be hundreds of dollars below the Class A product, if there even is any Class A product in some of these immediate submarkets. Another thing we love about kind of mid-80s and newer, they've all got big closets. They've got washer and dryer hookups. Who wants to live somewhere that doesn't have a decent closet? Who wants to go to a shared laundry facility? You know, not maybe you, but might like the social aspect, but yeah, not most people. Here's an example of more of a core plus asset we're taking a look at. But this is more of an example of just we're obsessed with attached garages. Because residents are obsessed with attached garages, especially, you know, if you've been in the Midwest with snow, no one likes clearing snow off your car. Who doesn't like a garage? And we've found in general that units that have attached garages always command a significant premium compared to units that do not have an attached garage. And it makes tenants very sticky, and we have a very high renewal rate. Let's look at how this all looks. And I'm just going to take my camera off so we can actually see this whole thing. So this is a pro forma for the Gray Fund. We've made several assumptions. This is not based off of any particular project. What these numbers are based off of are assumptions we are currently making on projects we are bidding on, returns we are seeing in our underwriting based on actual transaction prices, and laying out essentially a roadmap of what we think the fund will do. Obviously, it's a roadmap and it's a guide. And, you know, as the course, as we approach challenges or the market changes, you know, we will adapt accordingly. But we think a good roadmap is a good starting point and a good way to get to where we want to go. So in this first year, we're contemplating investing in 4 assets, deploying about half of the fund, $46 million. And then by the second year, year 2, we will have 7 assets in the fund and be fully allocated the full $100 million. And we'll be up at 8% project cash on cash return by the second year of operations. Now, after the second year and the third year, we contemplate the possibility of selling 2 assets. This would be after a value-add renovation plan was successfully executed, rents were raised, appreciation was forced, and we could then sell that asset. Another option would be to refinance that asset as well. Now, within the first 4 years of the fund has the option to take those proceeds and reinvest into new projects that will provide instant internal compounding to the fund itself that will be very accretive and allow for a higher overall return, especially those investors who are looking for upside and choose to go down that route. Throughout the rest of the period, you know, we hold on to most of the assets throughout the duration, although, you know, really starting really after the year 5 and 6, a handful of refinances and sales take place. And as we really kind of get past year 5 and 6, we're really more speculating. But the idea is, and this will be further illustrated in the next slide, is a good chunk of capital will be returned by year 6, about a little over 25%, which some investors, you know, will actually have all of their capital returned by that point in the investment cycle itself. And then by year 10, the entire fund is liquidated and we have a really nice kind of return, average 20%, 20.6 IRR, total cash flow by the end of the fund itself. Turn my video back on. So let's talk about more on the structure. We are, as I mentioned earlier, we're using a dual class structure, or you'll see this as A and B shares, A and B units. They're membership units is what we're calling them. Class A units, which represent 75%, Class A units represent 25% of the total equity. They feature a 10% preferred return that is distributed monthly, overall 10% IRR, but there's no further upside. And the reason for there being no further upside is the 10% preferred return, as well as having a priority position in the capital stack. And so what that means is that when cash is distributed on a capital event, so a sale or refinance, the first to be paid is the preferred return of the A unit, followed by a return of capital to the A units or the members with A units. After their capital is returned, then cash flow begins flowing to the B units. What this does is it lowers the risk for the A units themselves. Now, the B units, they're more designed for upside, whereas the A units are designed for income. The B units feature a 7% preferred return, an 80-20 split, the split between just the B members and the GP, with a 60-40 split after an 18% IRR. And we're targeting 18 to 24% net IRRs to the B class members. Now, since the A units are paid first, of ordinary cash flow, the A units will be paid first and then the B members. So on ordinary cash flow, the A units do not have to have their capital returned. And assuming that there is adequate cash flow, which we anticipate there to be, especially by the second year, the B units will also receive monthly distributions. However, they may not be at the full 7%, especially in the first 2 years. Any preferred return that is not paid accrues. And the reason that it will accrue and that they're not in the first position is because the B units are receiving the lion's share of the upside. Since the A units are capped at 10%, all of that additional cash flow flows to the B units. The result is an overall lower cost of capital. And the breakdown between A units and B units is 75% A units. Sorry, that's the second time I've misspoke. 25% to the A units, 75% to the B units. So 25% for the members that are going to receive a 10% preferred return, and then 75% to the members that will receive a 7% preferred return. But I don't like to look at it that way. I don't like to look at it as A and B as a binary choice. I think that, as I said, most investors are looking for a blended return profile, not just income and not just upside. And so I'm going to come back to fees in just a little bit, but that's why we've created a couple charts, and we're encouraging all of our investors to take a blended approach, not look at this as a binary decision, but using a combination of A and B units to create a tailored risk and return profile. So what does that look like? We've put a really great, I think, really interesting diagram, almost look at it as a dial. So you literally dial in your risk and return. So overall, over on the far left side, we're calling it total income. That's 100% A units. Again, that only represents 25% of the total equity, the 10% preferred return. That's going to be the lowest risk position, highest income, but your upside is limited. So your return is capped. If we wanted to go mostly income, but with a little bit of upside, we're recommending 75% A units and 25% B units. That'll produce a preferred return, a blended preferred return of 9.25%. An IRR projected to be 12.5%, and an equity multiple over a 10-year hold of just under 2%, or sorry, 2 times. Now, if you're looking for more balanced, you could go 50-50 A and B. That'll have a preferred return of 8.5%, IRR of 15 over a 10-year period, and an equity multiple just shy of 2.5. I think that's a great option for probably a lot of investors. But the profile that mostly mimics kind of our old structure of like a 8% preferred return, 70-30 split would actually be the growth weighted option. And that's 25 Class A, 75 Class B, essentially the same proportions as the fund is. That's going to give you a blended preferred return of 7 and 7.5%. With an IRR projected over 10 years of 17.5%, and projected to being a 3x equity multiple over 10 years. Now, total growth, all B units, no Class A. Again, you're going to get the 7% preferred return, a 19% projected IRR, and a 3.5 projected equity multiple. So the highest potential return, but highest risk as well, as you are in a subordinate position in the capital stack compared to the A. But that's fine. And a lot of investors, they don't have a preference for cash flow. They may have a great paying job. They've got income, and they're really trying to get the highest multiple on their capital as possible. That is where going all B units would come into place. But again, for most people, either the income weighted, the balance, or the growth weighted is going to make the most sense. But again, this isn't financial advice specifically. We're talking about real estate and real estate advice. Highly recommend you discuss this with your financial advisor, because I personally believe that if you're invested in bonds right now, you're trying to create income. These A units are a great way to generate tax sheltered income backed by real estate, backed by real assets. And then the beauty of the A units is since they only represent 25% of the capital stack, we know we can pay that 10% monthly. We require very little cash flow to meet that preferred return. And so nothing's guaranteed, but the threshold of meeting that preferred return is very easy to achieve. And we are typically tripling to quadrupling the cash flow in initial years beyond what that minimum threshold to meet that monthly distribution to the A units. I recommend looking at the deck. We have cash flow performers for all of the different blended A and B combinations. So, if you go to graycapitalllc.com/gray fund, you can look at these charts and kind of see what the projected cash flows look like. But the one thing to point out on this pro forma is you'll see in year 6, the Class A, the total income, where the Class A return goes to 0. And the reason for that is because there are anticipated to be several capital events in the 5th year, and which result in capital being returned to the A members. And once those A members' capital has been returned, that preferred return goes away. So now if you have a blend, you would still receive the preferred return on your B units. But when you're allocated to A, those units would be paid back, or less. We're anticipating them being paid back around year 5. Now, if those capital transactions don't take place, if we don't refinance, we don't sell, the A units would continue to stay in the project itself. If you'd like to get started, start having a conversation with us, the fastest way to do it is email William, who's our great team member, investment associate at Gray Capital. He's sitting right next to me. He's chuckling right now, I'm sure. But William at graycapitalllc.com. You can always email me as well, Spencer at graycapitalllc.com. I am having a third baby girl on Friday. Alex is being induced on Friday, so I may not be as quick to respond to your emails over the next week or so. I'll be back in the saddle here shortly, but over this next week, I may be not as responsive. And William, he's on top of it. So we'll email William at graycapitalllc.com. If you don't have this deck, of course, you can go to graycapitalllc.com/the Gray Fund. Oh yes, Ian, thank you for reminding me. Let's talk about fees for a second. So our idea with the fund was to be as fee efficient as possible. We want to raise $100 million to go and buy $300 million worth of assets, because that's how we're going to grow our own wealth and build our business. And we're looking forward to the second fund, the third fund, and the fifth fund. Did I miss a fourth fund? We're looking forward to subsequent funds, and this being the foundation. And we need this. We need this to be as successful as possible. So we're not trying to charge that many fees. The 4 fees that we do have in the fund is a fund management fee, which is charged only on invested capital. So it does not start charging when you just make a commitment. It's only once we've actually invested that capital. It's a 1.75% fee. We will have an acquisition fee on project that is up to 1.5%. It could be as low as 0.75% and just a maximum of 1.5%. A property management fee set at a max at 3.75%. Most of our property management fees will be in the 3.25 to 3.5% range. And the loan origination and guarantee fee, we have a 1% maximum. Jesse, the presentation you can download. The easiest way to download the presentation, so one moment, is to go to graycapitalllc.com/Gray Fund, and find my spot again. graycapitalllc.com/Gray Fund. There's a quick form. All you have to do is put your email address, and I think your first name, and you'll be sent the deck. Now, this video itself will be made available. You'll get an email, but we'll also be posting it on YouTube at a later date. But just to go back to the fees, just to make it clear, because I think there was a couple of questions on the fees itself. So is the asset management fees assessed pro rata at property or so the acquisition fees are assessed at closing. The ongoing, the fund management fee or an asset management fee, we don't have an asset management fee. We will only have a fund management fee, which is essentially the same thing. But just to clarify, we're not, a lot of groups, most funds have both an asset management fee and a fund management fee and like an equity placement fee. We had to strip, our attorney suggested we stripped all of those out. So the AM fee, that's going to be assessed on a monthly basis, or paid on a monthly basis, as all distributions are. And that is based on invested capital of the fund itself. I'm happy to take any other questions about the fund. I know this is a thorough, long presentation. I appreciate everyone sticking through. For those of you that did, and for those of you that did stick through, if you get in touch with us, if you get in touch with William, if you'd like, we've got these really cool Great Capital water bottles, and we'd love to send you one. Send an email to William at greatcapitalllc.com. All we need is your address, and we'll not only send you this, but we'll send you a printed version of the deck as well. No, absolutely, Ian. I appreciate you being on the webinar. Explanation for the max qualifier acquisition management fee depends on the lender and third party or property manager. So the max is really what is accretive to the deal. We wanted to set a max that is moderately low. I mean, most acquisition fees are 1.5% to 3%. I mean, the lowest you'll see is maybe 1%. We wanted a set that will never exceed this number, and we may be lower than that on the right deal. We'll lower that acquisition fee or property management fee. Property management fee, we always try to get as low as possible, even if we would be the ones managing the asset ourselves. Now, if anybody has any other questions, please feel free to put them into the chat. If you'd like, though, send them your questions on over to William or myself. We're happy to hop on either Google Meet or Zoom with you to walk you through the presentation, as well as walk you through the process. And that's one thing I didn't get into too much, just because we're running out of time. All of the partnership documents for the Great Fund will be available by the end of next week. You can go ahead and start your commitment process at greatcapitalllc.com/greyfund. And then we'll have those documents, being able to send them over to you. You'll be able to do it through the investment portal at greatcapitalllc.com, or you can, we can send you the documents directly through an Adobe sign. Yeah, that's a great question, Greg. What about a market downturn? How will it affect real estate in these investments? I think that's an excellent question. That's one of the reasons why we like the markets that we're targeting, is because they have been so undersupplied. And so if there is a decline in economic activity, they are much more insulated and resilient. Specifically, if we look at the last two recessions, 2008 and the COVID recession back in 2020, Indianapolis was relatively unscathed. I mean, certainly it wasn't good for any market, but Indianapolis had the second least amount of jobs lost. The only market that fared better was Salt Lake City. And back in 2008, I mean, there was a decline, but it was not significant. We don't see the major booms. We see more linear growth. And that's one of the reasons why we're choosing the markets that we're choosing. I would say, for a market downturn, we think about this a lot, is where are the alternative investment opportunities and how will they be correlated to an economic downturn? And we're really comparing, you're really talking about opportunity cost. And, the public equity markets could have opportunities, but I think that they will be much more severely affected by an economic downturn, as well as other asset classes. And again, coming back to speaking with Noah Stone, the head research analyst over at Berkadia, the fundamentals behind multifamily are so strong right now. There's such a lack of housing that it would have to be the amount of energy it would take to knock multifamily off course. Not that it can't happen. And there's a lot of building, a lot of our markets that's concerning right now, but we're relatively insulated and we believe we at least have a good 5 years of runway, at least in the markets that we're looking at. Can you talk about the approach to debt and the assumption of rising rates? Absolutely, 100%. In general, we are not going to be exceeding 80% loan to value, and on average, we'll be closer to 70% loan to cost, really kind of 75% loan to value. A lot of we close often on a bridge loan and immediately take it out with a agency, either Fannie Mae or Freddie Mac. Currently, we're underwriting acquisition interest rates in the 3.75 to 4.5% range. And then any kind of refinance interest rates, we are underwriting in the 4.5 to 5.5% range. Now, recent quotes from Fannie and Freddie and our bridge lenders are still sub 4. They're kind of 3.5. So that would take significant movement. Currently, the lenders have widened their spreads significantly. So as rates will move, as they certainly will, just how much will they move? There is some flexibility amongst lenders. Our goal, though, is to eventually move all of these loans over to a Fannie Mae facility, which requires to have $100 million in debt to be able to establish this facility, and allows for an incredible amount of flexibility and to get the absolute best pricing across any market. And that's another advantage of the fund, that you can't do this with a single syndication. You can't get the best pricing from the agencies. And by having a large enough pool of debt, it becomes incredibly attractive. And so having this large pool of debt, it allows for greater flexibility with our loans, lower interest rates, better terms, better spreads. And so that is our eventual goal, is to use a Fannie Mae facility with bridge loans for the acquisition. And in general, just to talk about inflation assumptions, because I don't know how many other sponsors are doing this. We believe we will be in a moderate inflationary environment for the next couple of years. We are underwriting higher expense inflation. The typical expense inflation is about 2%. We're using 3 to 4% expense inflation. We are just assuming payroll is going to be higher on our initial years, higher than in the past. We used to underwrite about $1,000 per unit for payroll. Now we're closer to $1,200 or up to $1,600 per unit. We are anticipating higher utility costs. In general, just using a higher expense inflation, higher interest rate assumption as well. It's tough though, because we're using higher rent growth assumptions, at least in the first year. And again, most of that is just the absorbing the difference between the effective rents and the organic rent growth. And then we're tapering it off really after the second or third year. We're tapering growth off significantly. I believe that at some point we're going to revert back to a slower growth environment and lower rates eventually, but we got to get through this inflation and higher rates first. And I guess just the last thing on debt, we have some incredible relationships with lenders. A handful of them are local, good friends with the CEO of a very large lender here in Indianapolis or in Carmel, Indiana. And we have some great contacts with several large national lenders on the agency side as well. And again, it's one of the advantages of the fund is the economies of scale. It becomes much more attractive to lenders. We become much more attractive to brokers. The economies of scale in terms of renovations. So, we're looking at a portfolio in Indianapolis that's a little under 900 units, 830 units, that all require similar renovations. And so renovating 830 units in the same way versus 200, we have a lot more power in terms of purchasing and getting better pricing when we're doing things at scale. And I think doing things more efficiently is, to us, it's a no-brainer, especially when the downsides are pretty minimal. Well, again, if anyone has any questions, please reach out, William or myself. Again, my email address is spencer@graycapitalllc.com. William will be able to get back to you immediately However, we are going to continue doing these webinars. I believe it's the second Tuesday and the third Saturday of every single month, probably over the next 6 months or so. Really probably until we get the fund completely raised. This is a pretty broad overview of the fund. We're going to go into more specific topics in the future, including risk factors, doing a deeper dive into the themes, examining the pipeline. And then as soon as we do have assets in the fund, we'll be doing monthly webinars and conference calls, updating on the pipeline, the current performance of the fund, and anything else that's going on in the fund as well. All right. I really appreciate all of you taking the time to watch this webinar. This is an exciting time for Gray Capital. It's an exciting time for myself. We've been working towards this goal for quite some time, and we're so confident this is the right vehicle for the right time. There's a lot of uncertainty out there in the market right now. I think to Greg's point, Russia's trying to roll over into Ukraine. How that's going to affect the demand for housing in the Midwest is yet to be seen. Certainly, things are correlated and things can affect each other. But when we're looking at supply and demand, and if anyone is subscribed to our Gray Report, YouTube channel or the newsletter, we're tracking all of this very closely and trying to find where the black swan is. Because again, we're not making our profit isn't necessarily coming from the carried interest and fees. I mean, that keeps things moving, and that's great for the GP. We're putting our own money to work in these deals as well. We have significant amount of risk in these projects in skin in the game. Again, most likely the GP will be the largest contributor of capital to the fund itself. And so we're looking this through this very same lens that most of you are looking at, of where's the best place to put our capital in this type of economic environment that we've never been in before. Very few active investment managers in the world were even active during the late 70s, early 80s when we had an inflationary environment. No one's lived through a pandemic or invested through a pandemic. No one's invested through inflationary environment and a pandemic, in the modern age where we have social media and smartphones. So we're in a new spot. I think the best we can do is keep our ear to the ground, keep both eyes wide open, look for the opportunities, not be reserved and sit on our hands, be cautious. And when we see the opportunity, move forward. And that's what we're doing. We see an opportunity, multiple opportunities right around us, and we're moving forward. So thanks again, everybody. I appreciate this. I hope you have a great rest of your week. I'll hopefully see you all soon, either a meeting. We're going to try to do some investor events throughout the year. And again, if you're not going to email William, I totally understand. GrayCapitalLLC.com/GrayFund. If you fill out that form right there, you will be sent the investment deck. Again, that's GrayCapitalLLC.com/GrayFund to receive the deck, which has pretty much all of these slides. It doesn't have all the graphs. It has a little bit more written word, less formatted for a webinar, but it'll get you most of the information. And as I said, we will be releasing supplemental documents as well, including deep dives of all the markets, all of the assets, themes, risk factors. It'll all be available soon. And all of the deal documents will be available on the Gray Capital portal within the next week. All right, everyone. Hope that you have a great rest of your day, and we'll see you soon. Thank you.